The job reflects my character. I always want to know something more. But the other dynamic, when I started my career, is I wasn't very good at conveying what that something more was. And today, we're going to have a class, hopefully, about how to learn something more, what the basics of that are, and where to look, and how to convey that. Now, the format of the class is pretty tedious. I have slides. I'm in front. I'm talking. You need to know something about me. About 10 years ago, I had a very bad accident. Had a concussion that took more than 90 days to clear. And wasn't diagnosed with any kind of brain damage until 3 years later. And I got diagnosed because I came home from the hospital after a surgery on my neck from that fall. And I opened up my notebook. And if I had printed it, it was just fine. But if I wrote in cursive, which is what I wanted to do most of the time, it was in a different alphabet. Didn't recognize it. So I had to learn to write again. This means that there are gaps. And if I've forgotten something, or if you have a question, it is your responsibility to keep me honest and covering those things. So I want you to ask questions. I have a tendency to go too fast. Typically, people in our business do. This is why what you're doing is so hard. I came here today because I was a grader last year. And I was very frustrated by the quality of the reports that I graded. And it wasn't that the reports were missing things or weren't thoughtful, but they were not thought out in the many reports that I graded, and they weren't made to be persuasive. And those are very important parts of what we do as analysts. So that's why I called it content and delivery. You can go to many more people and learn lots about how to make research content, how to create it. We're going to cover that, much of the talk, but delivering it may actually be more important than the content, particularly when a stock is moving extraordinarily rapidly against your recommendation. Okay, we're going to have 2 sessions today. I had planned a half-hour break in the middle. I don't know what we're going to do now that we're starting late. This first chat is going to be about content basics. And if I say something, I want you to question me. I'm going to try and ask myself, how do we do this? If I forget or if I miss, please, again, ask. This is also an overview class. This is not a detailed class. I've probably spent hundreds of hours studying 1 or 2 slides in this, and most analysts have. So you have to catch this very quickly to be competitive. Hopefully everybody has prepared and brought their copy of Equity Research Report Essentials with them. That will be important because we're going to use that today. And then everybody has seen the video of best practices for research analysts. Has everybody seen the video? What do you think? I thought it was pretty good too. I was prepared to not like it. Nobody knows more than me, of course. Oh, I didn't notice that. I'll have to give him a better review. I thought in an hour he covered a lot of good ground. And again, if you haven't seen it, I would encourage you. Data resources are critical. Unfortunately, in the hierarchy of the CFA, I don't get them the way you do. Because I am a CFA and a mentor, I'm not a student. So I don't get to look at the data. It will cause a small problem in our presentation, but not much of one. And then you need to know about a bunch of research tools. And research tools are everything from how do you ask managers questions, which we are not going to cover today, to how do you keep track of all your stuff when you're building research. So, we shall start. Okay, what is an analyst's job? You in the plaid shirt with looks like a gray cap and a yellow sticker.
Mm-hmm.
Caught you with your mouth full.
Mm-hmm.
What is an analyst's job?
Essentially to look at a company's business and prospects and decide going forward how it's going to work.
Okay. Anybody else? Blue shirt. I'm picking on you because you've been chatting.
That's okay. I finding supply and demand of a certain amount of commodity in the stock market.
Predicting it.
Okay.
Anytime you're dealing with an investment, the question is what is going to increase or decrease the change of demand for that investment product. So knowing that, what does that give you the ability to do if you know how to predict that with some reasonable consistency? Woman in the gray striped sweater next to the fellow with the Boston cap.
What's the question again?
One of my team people who I haven't really met yet, the fellow in the black t-shirt in the middle. Well, you can see that, or you saw it earlier.
That's right.
It's not right. If you can predict the supply and demand for an investment, you can go into the market and make money for yourself. If you have a lot of money, that's enough. Okay? Because you can live on it. I've been doing that for a few years now. It's a little scary. So I don't have a lot of money. But that is a skill that you have to develop and understand completely before you can get to the next step, which is to change other people's opinions. And changing their mind is what makes a market. Now, there's an old joke that investment firms are in the storage business and brokerage firms are in the moving business. And there's a fair bit of truth to that. Brokers get paid when stocks change hands. Investment firms hold on to stocks that they believe in to generate above market returns or to generate returns in line with their charters. If you can't persuade somebody to buy or sell a stock, no amount of accuracy and reputation here will make you successful here. Okay? You can be really smart. You can be really great at picking stocks and bonds, markets, commodities, whatever it is. But if you can't bring your team with you, if you can't communicate that to your boss, or if you're working in published research, if you can't communicate how people should change their minds and how they think about something, you're worthless. I have a very dear friend. I've known him for a very long time. He worked at Seagate Technology. I was fortunate enough to be an analyst who got hired to do some work for a company called Oak Investment Partners, which is a venture capital, now we call them private equity firms, who did Seagate's first round. My friend knows more about the disk drive business and the PC industry than anybody. I mean, he really knows his stuff. He went to work as an analyst. In stock picking, he had the best stock picking in the firm, off the rankings. He lasted a little bit more than a year before they fired him, because he couldn't persuade anybody. He couldn't get the salesman behind him. He couldn't get clients to listen to him. I mean, I've known this fellow for a long, long time, so I listened to him. But that wasn't enough. You've got to be able to persuade people, and that's really critical. Now, the question is, how do you change people's minds? Well, the traditional approach is you research the company and you research the stock. And you come to a conclusion and you make a recommendation. But again, that's like being able to predict the market. That's a necessary but not sufficient condition for success. You need to communicate your conclusions. You need to put things in context. For example, Fiat may make the worst cars in America if you judge the quality ratings. However, the stock is selling for 1/10 the valuation of Ford and GM, so I think that's more than reflected in the stock. And its PE is almost 3, while the other guys are selling for 7 or 8 times. Now, in a little statement like that, I got the person's attention by saying something they would agree with that was negative about what I was recommending, because they probably knew before the meeting that I liked Fiat stock, Fiat Chrysler stock. So I gave them context for the world, and then I brought it back and maintained context by moving the discussion to valuation and saying all these problems are more than reflected in the valuation. Now that's what you as an analyst have to be able to do. Is when you make your assessment of the company and stock, because there's more to the stock than the company, you have to be able to provide context, and you have to be able to demonstrate that you know what you're talking about. And just now I demonstrated subject matter knowledge by knowing the J.D. Power scores, whatever scores they are, and knowing the valuation of auto companies in general. But that's what I mean by context incompetence. Anybody want to try presenting a stock idea? Okay. Right answer. Now this comes straight out of the CFA program with a minor addition for me. These are what the society says need to be in a research report, and they put investment risks in as one of those essential things. I think you have to do at least one more thing when you convey your research. And you have to be thinking about this one thing every moment you are working on your research and once you launch your opinion on the stock. And that is, I need a thesis. What is the reason that there's going to be more demand than supply for this stock in the future? And again, I'll go back to that little Fiat thing. My basic thesis on Fiat is that it's cheap. I didn't tell you this, but earnings estimates have generally been going up on the company, and it really does sell for less than half the valuation. When I got involved with the stock, it was selling at 10% of the valuation of the other auto companies. Sorry? Well, there's a bit of a lesson there, is that you make money on the outliers, you don't make money in the mainstream. But that's a whole other discussion. So always be thinking of these things in terms of your thesis and your risk assessment for the company. Like with Fiat, I addressed one of the risks right up front, or a risk that everybody's going to think about. They make crappy cars. Sorry, still cheap. But again, these are the things that you have to do. Now, this section and this section, we're going to come back to, but that's how we're going to structure a report. Right now, what I want to do is shift a little bit to getting from the report structure, which you see here yet again, to getting to research. The basic information that somebody gives you about stock on that front page of that report, more than anything else, it has to be completely accurate. It may not have to be accurate tomorrow or yesterday, but at the moment in time that you print that, that has to be completely accurate. You will instantly lose the attention of whoever you're listening to if you said, oh yeah, no, I'm sorry, Fiat's PE is 14, not 3. And you make a mistake like that. Or even if you say it's 5, not 3. Where they're going to earn $3 when they're really going to earn $2. Whatever it is, this information has to be completely critical. That is your permission to walk into the room and talk, if you will. The next thing is, what are you there to do? You're there to change their mind. Now that may be to strengthen their opinion. That will have resulted in a changed mind. It might be to affirm or deny their opinion. So, what you talk about next and what the report talks about next, and this should be right on the front page of the report, is a succinct investment thesis. Sorry about that. Turn that off once it stops. And again, okay, I'm going to pick on you because you sent me email and you made a mistake like I make, showing up on, thinking that I was supposed to show up on the wrong day. Okay, IBM is a very controversial company today. Its growth rate has slowed. In fact, it hasn't grown for 3 years. Why would you buy the stock? Give me a thesis for why you might buy it. It doesn't have to be an accurate thesis. Okay? It's yielding 4%. It's compared to other industrials, it is selling for a lower general valuation.
It has good track record.
I just told you it hasn't grown in 3 years.
It is a good track record, like over the years.
Over the decades.
Yes.
Okay, but it's not growing now. Why is that not a concern? IBM was an engine of our economy. You know, what's good for GM is good for America, what's good for IBM is good for America. Not really. Because IBM ran and provided most of the information infrastructure to Hitler. Okay, I'll just pick on IBM. IBM's growth has been challenged as it has moved away from asset-intensive business towards more service-related business. However, the valuation with a 4% yield and selling for materially lower PE that companies like GE and Honeywell, who are really not going to grow that quickly, makes IBM an attractive investment. Okay, red sweatshirt, Adidas t-shirt.
Yeah.
Pick a company and give me one, or I'll pick a company for you.
NVIDIA.
NVIDIA, okay. That's a good one. It's one of my favorites.
Yeah.
Both long and short. It's been a great stock for me over the years.
You want an investment thesis for it?
Yeah.
I would say that NVIDIA is an attractive buyer now, due to the fact that it's in an industry that outperforms the market, and more specifically, it's experiencing high growth due to superior products.
Okay. What industry is it in that's growing faster than the market?
I would say the technology sector, and specifically like microchips.
Okay. You just got a fact.
Okay.
And clients will do this to you. So you have to be aware. Set you over that.
Okay.
You have the misfortune of picking a stock that I have traded, I've been right, I've been wrong. I mean, I'm out of the stock now, I should be in it. But NVIDIA serves the handset market, doesn't it? That's their primary market. That market's contracting if you measure the revenues of the industry. There's traps. Okay, anybody want to try a telecommunications company, Sprint, Verizon, AT&T, or T-Mobile? You want to give that a shot? You can't have a wrong answer. You get points for standing at the plate. Sir, go ahead.
Why not? So about Sprint. So obviously they've been on kind of a long slide in terms of subscriber growth and everything else. But if you look recently, it seems like they may have hit a bottom. Their churn on postpaid is coming to the lowest point it's ever been. And their network is also finally caught up to the others. So it seems that they've made the investments they need to make. Going forward, they should be in a good position to build market share and therefore value.
Now, you've just spoken music to my ears because Sprint is my largest personal position.
Perfect.
But that's generally something you could say about stock. You didn't address valuation because you don't have valuation numbers in front of you. I didn't give you valuation on any of them. Why is AT&T a sell?
I believe with all the issues, maybe I need to continue studying with the acquisition of Time Warner.
That's the perfect answer. Do you know what AT&T is going to look like after Time Warner's there? You don't know. Okay. So you go in and say, I can't make a good forecast for AT&T. I can build a financial model that shows you what it's supposed to look like. However, they've got these overlapping businesses, and we don't know how much of that's going to crash. Good answer. Yeah?
Would you factor in, I know I've seen in Wall Street, some of the investigations into the monopoly potential there with them acquiring Time Warner? I've seen that in Wall Street. Would you address that in terms of potential legal issues, or just say, I think?
Okay, did everybody hear his question because it's a good one? Would you address the legal issues associated with a merger, or the regulatory issues associated with a merger? And the answer to that is absolutely. As an analyst, you have a company that's kind of facing something with a regulator, you need to know the issue, not only that it's facing something with the regulator, but what those issues are. And before the regulator ever makes a ruling, you need to have an opinion as to what that ruling is going to be and be able to defend it. So that's a good question, and that's a classic thing in securities analysis where you have to pay attention to lots of stuff. Okay, the next thing, business description. That's easy, right? AT&T provides phone service. It's not quite that easy. AT&T provides wireline service. They provide fiber-based service. They provide cellular service. They have a satellite company, DirecTV. They provide entertainment. They provide information services. They provide lots of different things. The business description has to quantify those things. Now, generally speaking, when you have a complex company like an AT&T or even Arrow, I'm not supposed to say that, they will tell you about their big chunks of business that makes it easier for you to forecast. But you need to be able to describe each one of those big chunks. And again, wrap it with your investment thesis. We think AT&T's fiber business is a dead end. Might be your first, if you in fact think that. I happen to think it. However, they do better at mobility than anybody else, and they generate higher rates of return. But you always want to be putting what you write here in context when you describe the business. We'll do a lot more on this as we go through. Management and governance, how important is that? Pretty important. Why?
Drives the vision of the company, of the management.
Depends on the thesis. I mean, if I'm going to be in a company, long time holding, I obviously want to have good management and governance. If I want a shorter company, maybe I'm looking for the opposite. Maybe if it's a tactical short-term trade on.
Yeah, it's an important factor.
I don't.
It doesn't have to be positive or negative.
Yeah.
You have to just take it in stride. But it's a reasonably important thing. Now, there's two parts to that: management and governance. And one part are those words that are never spoken or written, what you really think about management. Unfortunately, we rely on management for information. And if you say things that are tart, like Dan Hesse, the CEO, is incompetent, there's a very good chance the company will stop speaking with you and stop provide you with only minimal information. And you don't want to turn that off, even if he was incompetent. Okay, industry overview and competitive positioning. Again, rapid and thesis. We have 4 cell carriers. AT&T charges more than anybody else, and they have the second best network out there. We think that's going to come more in line, and that investors will be disappointed by their income growth. It's as simple as that. There's a couple devices we'll go through. on both competitive positioning, valuation, and then the whole second half of our class is going to be about financial analysis. And risks we're going to talk about because that was one of the things that was handled extremely poorly in the papers I looked at. Okay, going back to researching the business, you have to define what is the basic nature. And this is funny. I used to cover the electronics industry. And the typical electronics company back then had a very huge fixed cost base. Tremendous incremental margins. So small changes in the sales, where your confidence that the sales outlook was improving, would have huge impact on the bottom lines. That's how electronic investors thought. I started picking up the disk drive industry. It's not how that industry works. And people were shocked when you tell them something so basic, that this is a high asset turn business. Look at a semiconductor company, it used to be about 1 time a year. Look at a disk drive company, they're going to turn their assets 2.5, 3 times a year. So you have to be able to describe the business, both in terms of Seagate makes disk drives that store information in personal computers, but you also have to say, this is a high turn business, relatively low margin, very different from, and maybe contrast it with other names like Intel or Micron in the electronics business. Okay. Gentleman in the gray shirt to the far left, it's like a Under Armour shirt. Okay. Are you familiar with can you think of a good public company around here? Teletech. No. Okay. Are you familiar with Camp Bow Wow? That's been a hot stock in Denver. Do you know the Discovery Channel? Okay. How would you describe the Discovery Channel?
Probably known.
I can't hear you.
Probably known. Probably known.
Yes.
Words.
Okay, I've just done something to him that's going to happen to you when you're an analyst talking to customers. They'll ask you about a business that you don't know too much about. Okay? You can't say, oh, it's a public company. You got to say it in the context. Well, most of my work is on the moving of information business, and they're in the creating of information business. They're a media company, so they're in a similar universe as mine. My general impression is they're not doing as well as the rest of the industry, but that's simply based on what the cable companies have told me. I mean, again, context, a little bit of context, a little bit of information takes you a long way, and you sound intelligent. Even though, like you, I don't know a damn thing about Discovery Communications. Okay? So again, that nature of investment thesis and context is critical. You need to develop a set of metrics for the company and the industry. If we go to my electronics model, the key metric that helped me explain the disk drive industry was asset turn. And asset turn, and then you break that down to inventory turn, day sales outstanding, and then what we call the cash conversion cycle. Does everybody know what those 3 things are? Okay, good. You have to choose the metrics that are most relevant for the business. There is not, I cannot tell you that incremental profitability is universally applicable. I can't tell you that year-over-year comparisons or quarter-to-quarter comparisons are universally applicable. It depends on the nature of the business, and that's the kind of judgment you need to make when you're an analyst. We'll talk more about competition, but when you're researching the business, you better touch on it and get a glimpse of it while you're thinking about it. You don't need to make a whole big thing about it. strategy, and in management competence. Now remember, this is researching the business, not communicating the business. You have to have an opinion about management. Okay, you need to know where your company fits in the economy. So you need an economic backdrop. At this point in your careers, I'm going to tell you just pick one. There are, most investors, most really good investors, are far better than any strategist on the sell side. So do not necessarily think ill or think poorly of it. They do it themselves. They do it because they've had years of experience. In the absence of it, if you see like a whole bunch of confusing opinions, not that Wall Street would ever do that, just say, I'm assuming the current growth rate of the economy continues and that we will have a flat stock market because there won't be a lot of changes. But that, again, is a contextual tool. And it's a contextual tool, A, in terms of the tone of business, the cycle implications, and also for valuation. If you think about a company like Caterpillar, when does it get its highest PE?
Right before the crash.
I'm sorry?
Annually or
Over a cycle.
like late winter, spring, maybe? Because people are buying the equipment in anticipation
Bottom
of
of
summer.
Caterpillar sells for its highest PE when its business is at its ultimate worst. Because it's not generating enough. It's a very cyclical business. They go through booms and busts. If they can make money in the bust time, they have a PE. Otherwise, it's infinite. So investors are willing to put a high multiple on that in order to discount the likelihood that business is going to get better and they're going to get more dividends and more earnings and more stock repurchases and all sorts of great things that affect the supply and demand of stock. So this is what I mean by you have to pick for your companies the right metrics and the right context within the economy. That's what the cycle tells you. For example, if you are late in the cycle, like we are now, and this is a very strange stock market that we're in, an economy that we're in right now. We're much more of a control economy than a market economy right at the moment. If you are in the late cycle, what do you do with your portfolio? You think you're near the end of a long bull run. I'm sorry? Go ahead, speak up.
More defensive stocks?
More defensive stocks, that's exactly right. Because the thinking is the inevitable is going to happen. And you want to hold things that are going to be solid. So things like Colgate or P&G, I don't even know which of these are public anymore. But you want to hold a consumer stock that's an essential. Beer is sometimes counter-cyclical. So is cable television and pay TV in general. So those are the types of names you look at. Okay, the world is coming to an end. The earnings per share for the S&P 500 are down, say $50. Just awful. What kind of stocks do you want to own then? Go ahead.
High growth stocks, which we expect.
High growth stocks. That's part of it. If you're a growth investor. If you're not a growth investor, what kind of stock do you want to own?
Income stocks.
That's a defensive stock. Do you want to be becoming defensive when the market is at a low? You want to do the opposite of what the market says.
Depends what your outlook is.
So I defined it as being a low point in the cycle. You want to think about your stocks from the standpoint of who's going to get the most snap if business gets better. Usually that means the junkiest companies and the highest growth companies. So again, these are all contexts that you need to provide and need to think about as you're going. I just did a quick one thinking of Chipotle. Okay, again, not a company I know particularly well, you might say something like, the outlook for restaurants is pretty mixed. I mean, we see all kinds of different returns. Nobody's booming, or very few companies are booming, and a lot of companies are in slower growth mode. This is a product of a low growth economy. This is maybe declining real wages coming to our discretionary real capital or discretionary spending. You have less money to spend. Now, within the sector, Chipotle's segment, fast and casual, is the fastest growing part of the restaurant business. The food is better than fast food, less expensive, and the emphasis is on value, which addresses these problems. But this is the type of discussion you need to be thinking about as you research a company. Does this make sense? Does anybody want to, nobody wants to pick a company and tell me how to explain it now. We'll move on. But that's what your working sector and segment's about. Yeah?
Do you have with the restaurants, I've heard a lot about the potential for lower healthcare or health insurance related costs. Do you have a view on that? The market seemed to think it was true.
Lower healthcare costs.
Because of the potential
Right.
rolling back on Obamacare.
That's a really good question, because I just fell into a trap. Talking about the top line of the business like it was everything about the business. And your point is really good, because you really have to address costs also. And that is certainly an economic variable that you got to address. So healthcare costs going down. Chipotle's average worker works about 24 hours a week.
So not a big issue for them.
Not a big issue for them, not likely to hurt them. If anything, it may be good for them because they can give people more hours per week, they'll get better at their jobs. However, the offset is minimum wage is going up.
Yeah.
So, but no, that's a really good question. And like I said, I fell into a trap when I was preparing this slide. Okay, now strategy. How do you analyze a company's strategy? You know the Boston Consulting Group, you know that model? Fund stars, milk the cows, sheep the dogs, and trying to figure out how to do something with the unknown sector. You can apply that if you want. You should go through that exercise for yourself. You probably don't want to share that with the outside world unless it's very positive about the company. The first thing you have to know is, what is the company's strategy using the company's words? Like the CEO Sprint. Our job is to provide the best value proposition in mobile service. Very simple. I think if you ask John Ledger what his strategy was, we want to overcome the pain points that consumers feel when they do business with cellular companies. If you ask Verizon, what would they say? Blue shirt. Better network. You got it. Very simple messages. But you have to put those messages in context. And I'll show you some reasons that's a fallacy. Then you have to do the work to affirm, deny, or put a caveat around their strategy statement. Like, in order to complete their strategy, they need to spend $43,000 billion on capital spending in the next 6 months. And we don't think the shareholders have anticipated that. Good strategy, though. Okay, we touched on this before. Again, this is something that you've got to think about, and you have to know how to couch. I was short Sprint for a very long time when Dan Hesse was CEO. And he was the primary reason I was short the stock, because I just thought he was a really bad manager. I didn't think he cared about the shareholders, but I was not going to write a report that says Dan Hesse's an idiot, because I need to talk to Sprint. But I had an opinion, and I would present that, and I would say, you know, I wrote a report one time that said, Hesse gets a few things right. Now, I was very complimentary about what he had done, but that suddenly puts the context to the customer. Why is he calling out Hesse doing something right? It makes them think. I've lost my mouse. Okay. Now, competition is very hard to research because it's a lot of judgment work. And most people see it that way. I want to try and boil this down for you on researching competition. Again, it goes back to choosing the right metrics for your company. Here are some. This is not an exhaustive list. Okay. And then measuring their competitors on those things. That way you make a dispassionate ruling. For example, Fiat's inventory turn is above the industry's. I like that. Superior attribute. However, their ability to collect on their car loans is below the industry average. I don't know if that's true or false, but you give an undeniable statement about how they stand competitively, and you have a bunch of metrics to do that. And you can use those metrics in a discussion. I would strongly encourage you to do that. We're going to show comparative valuation later, which is part of competition. But you need to understand these metrics. And then how do you convey it? I mean, you can convey a bunch of numbers that really isn't that compelling. It helps you make a judgment. You have to know them. Well, I like T-Mobile better than Sprint. Why is that? T-Mobile has an assured source of funding in Deutsche Telekom. With the company generating the returns the way it is, Deutsche Telekom has moved from being a seller to a buyer of the stock. Okay? How do I describe T-Mobile's position or the cellular industry's position? Everybody know Porter? Michael Porter? I remember this came out a few years after I graduated from college, and this was revolutionary. And it tells you what a nice model this is, because it gives you a framework for communicating to customers that they're used to, because everybody's learned it. I mean, I think it's great that they're teaching it to undergrads. So, if you don't know this framework, I think the book is called Competitive Strategy by Michael Porter, or Competitive Analysis, I forget, that long ago. But it is a great tool, even if you don't agree with his analysis that these are the most important things in competition. This is a framework for you to communicate. And that's often more important than you're saying this is a crappy industry or this is a great industry. Your customer will understand that. Oh, there it is. Okay. Valuation. This is another exercise in metric choosing. For example, if a company is an industry that's generally profitable and they have made a large number of takeovers and have considerable goodwill on the balance sheet and they are not reporting profits, what are some alternative ways to measure that company from a valuation perspective? You want to try? Have I called on you yet? Did? Who haven't I called on? How about the lady in the black dress, woman in the black dress?
You said what kind of types of investors?
Yeah, but if a company is losing money because it is reporting losses per share, because it has made many acquisitions and has a lot of goodwill on the balance sheet, and most of its competitors are making money, you're not going to use PE. What are you going to use? EBITDA, perfect. You're going to use EBITDA, you're going to use stable measures. Now this is how I tend to think of valuation, that there's two kinds of valuation statistics. There are stable valuation statistics, which when a company is losing a lot of money and not losing a lot of cash are very useful for any company using cash, because those are things like sales. relationship to enterprise value, how much debt there, debt service. All sorts of things that don't change very much so I call them stable valuation measures. And it's good to keep that in mind versus dynamic ones, which is classically price to earnings ratio, sometimes it's yield, or special dividends. So you have to choose your metrics. And then you need to do some more work. You want to look at the company's valuation over a long period of time. And in that period of time, you probably want to look at both stable and dynamic. Any of this stuff, and you could boil it down to a graph. And this is one of those things that I don't have for you today. Okay. This is time, and I just say multiple there. The reality is you're likely to have several different scales of multiples. And you do that because, you know, a PE of a company might go like this. That's a nice PE. Now that's bracketing, say, 17 times. Gets up to maybe 20, 21, goes down to 15. Gives you some advice on how the stock gets valued by the market, doesn't it? Okay. What do you do for sales? Price of sales. The PE is 15. What's the price of sales? Come on, be an analyst. Green jacket with orange trim on the inside.
It's not more.
The multiple of sales is more.
I don't think so.
Okay. Check your arithmetic. It's much less. Because your profits are a small portion of sales. Now, you might see price to sales doing something like that, because the market anticipates things. And it has places more reliance on sales. You might not be. I'm not saying that's the way it works. But again, you want to just show these things comparatively. Use different colors. Use every tool you can to convince your customer and make your message as clear as possible. And then the last point in valuation goes back to your business description. What might change? Why? For example, we think that company XYZ is going to sell for a much higher valuation. You need to go back. I think Cisco is going to sell for a higher valuation in the future because they are improving their asset utilization. And their ROE is going to go up. They're going to be able to delever faster than the street thinks. So it's going to sell for a higher PE. As simple as that. And by the way, that's a real story. I couldn't believe that I was negative on Cisco for a long time. I had an analyst that worked at the same company I did. He was the head of European research. He comes into me, John! I'd never met this guy before. Hello. I say, he says, I am Jean-Louis Prevedy, and you are wrong about Cisco. And we sat down and talked about it, and he was exactly right. And the whole thing was all about how Cisco was improving its internal asset deployment. Everybody on the street was focusing on top-line growth for Cisco, which is fairly common for a tech company. But his whole take on how Cisco was changing argued for a higher valuation. And that's a very simple argument to make. So I want you to get a feel that there's lots of different things. There is no one catalyst. I mean, a dumb thing like improving inventory turns or collections. Okay? You may have something else like their new product means, in the NVIDIA example. They do make a superior product. Their number one competitor got bought by another company who's done a horrible job managing. NVIDIA has free room to grow. And those are the things you can talk about here, but it all goes back to that basic company research for your context. Now, we're going to talk about this in the next session, and we're going to do this mechanically. And this is a lot of work. This is where much of your perspiration will go. Because everything you learn in what we've talked about so far gets built into your financial model. Now, I've tried to tell you what the basic elements of conducting research are. If there are any questions, have I left anything out? I noticed I didn't talk about customer research or things like that. Warehouse research or logistics research. Does everybody know what those three things are? No? What would be warehouse research? You watch the freight companies who ship the goods of the company you're writing about. And you find out whether they've rented a lot of warehouse space or not. It's not secret information. You might have to ask somebody outside the chain of command in the company. But you can know a lot. I remember I was at Storage Check one time, and they had an analysts meeting, and they had box upon box upon box of their new products, ready to ship off the floor. That was the thought. And I was very surprised because my best intelligence said the new product doesn't work yet. It's closed, but not there yet. So I went over and I knocked one of the boxes. There was nothing in it. It's a dumb thing, but that gives you direction of how the business is doing. It can confirm or deny. In my case, it confirmed. I was at IBM one time. I bumped into the box. I bumped the box there. The thing was full. It was going out. I was wrong to be skeptical. So pay attention to things like that. If you're following a coal company and those companies have been decimated, maybe a great place to invest right now. I haven't put any money to work there, but I'm working on it. If you're following a coal company, what's a metric?
Train volume.
Car loadings. You just said train, right?
Yeah.
Yeah, car loadings. Most coal moves by train. Just watch car loadings. Car loadings are going up. Look at the prices of transit. That will tell you whether the business is getting better or worse. Okay. I think we've now beaten creating research to death. Here is, hopefully, we've talked about all of these things here. And here is roughly how they map in to the different parts of a research report. There's a lot of continuity. And we can print this out and hand it out to you. It's not all that important. I just want you to have the idea of this is your work and this is your output. You tend to do a lot more work than you publish or put out. You learn a bunch of things that are useless. Like, did you know that Storage Tech has a machine that opens and closes their tape drive doors? And they test them until they fail. They have one that's been going for 8 years. Who cares? Not a factor. But you learn useless stuff. So this is how I would like you to think about all of these things and where they go in the report. Now at this point, can I answer any questions? Because we're going to go about how we convert what we've learned as a researcher into report writing. Any questions? No? I think I'm putting the woman in the gray sweater to sleep. Okay. So you guys all know how to manage all this information because I didn't hear any questions about this. For me, I found managing all of this information really difficult. One thing I noticed is that senior analysts, when I first got into the business, all of them carried a spiral binder with them, and they took notes. I thought that was stupid. You can remember what these people are saying. They don't make it difficult. About 6 months later, I started carrying a spiral binder. And that was really good, because I learned it in 6 months instead of 6 years. Now, I highly recommend using, does everybody here use Evernote or OneNote? No. You use it. You want to tell people about it? Or you want me to?
Well, okay. I use OneNote, so basically it's a cloud-based note application through Microsoft, and so like I have an app on my Mac for it, and then I can pull up my notes on my iPhone or like any PC if I download it. I think there's probably a web portal too. So it's just a way to have electronic notes that are kind of like Google Drive or something where you can pull them up anywhere. And then Evernote does basically the exact same. Has some other features. I think it has more writing-based stuff. And yeah.
They compete on features. Sometimes one is better than the other. This is a critical tool. It changed my life as an analyst. When I first tried OneNote, I have since switched to Evernote, and this is a very old notebook. Oh, you can't see that. This is what it looks like. This is about a company that the hedge fund where I worked was invested, much to my opposition. And I had to attack this company every day for several months before they got to sell it. It was a disaster. But notice, I have all kinds of notes here. I have what they said in their conference call. I have notes from the telephone call with them. So you can't see more than this, but here's another one. This is one I was dead wrong on. But see, you can, this helps you organize your notes. And it's a very powerful tool. You might just want to make a page called competition. ARO 0%. So you might want to have track things from Century 21, an H&B, and Abercrombie and Fitch. You want to track comments that relate to Aeropostale from them. You might have a page for that, just competitive stuff. And if you organize it properly, your newest stuff goes on top, and the oldest stuff is below. So it keeps you relevant. But I strongly urge you, as you do your work for the CFA challenge, because you're going to research a lot of things, right? Organize it. Okay? So use a tool like OneNote. I don't know that there's another one quite like it. But these are another company I didn't like. But these let you keep track of lots of things. Stuff I like for a while. It dates stamps things for you, so it's quite good. Let's move off of OneNote. Go back. Okay, data and modeling. That's my second 30 minutes, right? Good. Data and modeling. Companies may provide you with a financial model, a historic financial model. The company in this year's research challenge, whose name I promised I wouldn't say, and I've already said once, actually gives you that. You'll find it on the Investor Relations website. That is a gift. It's a gift in two dimensions. One, it saves you a ton of time building a model. And two, it shows you how management thinks of their business. Because how they model their business is usually how they think about it, or how they want you to think about it. Now that's really good. But there's another tool that you have here called FactSet, and I am jealous of every one of you because you have access to it. FactSet is a database that is miles wide and miles deep. You can use FactSet to download that model. If you think management is annoying about how they do things in their model because it doesn't correspond to what they do on the 10K or Q. God, gosh, does that happen? All the time. FactSet can help you with that sort of thing. When you're doing competitive comparisons, FactSet can help you because that will show you if you're modeling on one company, you choose download as reported. Okay? But if you want to compare a bunch of companies that are doing the same thing, you say download a standardized version, and they do that homogenization for you. So this is a very powerful tool. I would really encourage you all to become familiar with it. I am so old, I was their 5th customer for their online tool. Anybody want to guess who was president? It was in Reagan's first term. I'm a big believer in this. I've been using Capital IQ more than FactSet, mostly because I pay for it myself when I pay for it, and it's cheaper. And actually, I think it's, at this point, perhaps a better tool. Everybody know what Tableau is? No?
Yeah.
Okay, what's Tableau?
It's basically a visualization software.
Okay, what do you visualize?
I mean, anything, you know, basic graphing and stuff. They've got great resources for like map-based. You can do graphs over time, build dashboards, all sorts of things like that.
There's now other products than Tableau that do it. I think Alteryx is one, maybe? Something like that. I haven't really done anything with it. One of the limitations that you're going to find in Excel is Excel's logic is really bad. Okay? Gross profit in Excel does not equal sales minus cost of goods sold. It is B1 minus B2. So the logical structure of Excel is painful. Everybody uses it. You have to use it. Tableau is a much more data-centric approach. Does everybody know what I mean when I say data-centric approach? Okay. Everybody here know SQL? Yes? No? SQL is a form of a database that is very ingenious. It takes a flat file, like a worksheet. Okay? And it looks at the worksheet, and instead of having those relationships as geographic references, you can code logic into it, like gross profit equals sales minus cost of goods sold, and that gets your answer that way. But it also organizes the data with names, and then you create a relation. And for our work, the relation will mostly be time, quarterly, annual. And again, this is a very powerful tool for comparison because and you have to make decisions. Everybody has to be on the same calendar. Well, is everybody on the same calendar? Yeah. I mean, I don't know anybody who reports on the Hasidic calendar. Everybody uses the same calendar. Now, you might have to make a discussion of what is Q1, Q2, Q3, Q4. When is Q1? Q1 is a quarter that ends in February, March, or April. May, June, July, August, September, October, and so forth. This is a stupid thing, but you need to make that judgment because companies have different fiscal years, and they talk about their fiscal years very differently. Sprint, for example, is owned or controlled by a Japanese company. And Japanese investors talk about fiscal years from when they begin, not when they end. Sprint's fiscal 2016 just ended. Okay? So you have to equalize and plan to do that. Using a tool like Tableau or another data-centered tool, data structured tool, helps you make those decisions and do that smoothly. So I would encourage people to understand how to move data back and forth between Excel and Access or SQL. And if you don't, ask somebody for help on that, because that will help, again, that will help you organize and put your data together. Okay. So those are some tools, and those are really critical tools. Now, when you write your research, you don't tell them all about the things that you found and that you learned. That was fascinating to you. You made a judgment that that data point was important. Does the investor care? The investor wants to know why you're here. Buy, sell, hold. What is your investment thesis? So, while you describe your business this way, you present it this way. Always present your conclusion or your investment thesis first. And the reason I separate the two is sometimes firms give you one word to present your investment recommendation. Buy, sell, hold, or a number. And then you explain yourself. But you have to do that first. That's the most important thing. Again, that's to provide context to the rest of the discussion. Key metrics and basic information. We've talked lots about that. You need to highlight the most important ones. Not all of them. You don't need to show the investor that you know how many day sales outstanding they had in 2013. You need to show the investor that you know why their day sales outstanding is going to go down in 2017. But you want to highlight that. Here's where you talk about your forecast, how you make your forecast, your drivers and your risks. And then the rest of it is fairly what I described and what that paper describes. It's pretty simple. Okay. And this is a repeat slide, because this is important. This is the order in which you do things, so the investor thinks that you're competent and they think that you've done your work. Okay? Okay. We talked about what an investment thesis is. Is everybody clear on how to write one? Have you all looked at Arrow to some extent? Okay, somebody give me an investment thesis for Arrow. It doesn't have to be perfect, and don't worry about being wrong. But just convey to me, A, you think well of Arrow? Should you buy the stock, sell the stock? What is it, and why? In 2 or 3 sentences. Okay, the fellow looking at his phone with the Under Armour shirt. Since you were looking at your phone, I'm calling on you. Give me an investment thesis for Arrow. Quickly. All right, next. Boston Red Sox cap. There is no wrong answer here. Just try for the structure of it. Go for it. Just jump in. You're not graded on this. It's not on the exam.
No, it's like, recommendation B, let's say, hold. Context behind that would be just where the industry is and where they're currently positioned, based on just some of the fundamentals of the background and underlying business and the current economic conditions.
That's fine. You did it. Okay? The thought was, the first part of your investment thesis is what you're going to do. I want to hold the stock. That means probably I want to sell the stock or not put new capital in today. The reason is I don't think the company has got much stuff changing, so its growth trajectory is not going to change. And by the way, we're late in the cycle, and this is where companies like Arrow may get hurt. Is that a fair translation? Yes. Good. So I have this here because throughout your report, you're going to come back to hammer those points again and again and again. Now, here's a couple of samples. And I made these up for the class, and I went looking through my own research, and here's a really lousy one. Because the investment thesis on Leap was not it's going to be an event-driven stock, and we think we should use a long-term plan on it. The investment thesis was Leap Wireless has a ton of spectrum, and it's not reflected in the market value. You should own the stock, but you're going to have to be patient because their fundamentals are terrible. This is a lot less persuasive than what I just said, I think. Don't fall into that trap. This is a trap that all the papers I look at fell into. Less is more. And I compounded the error because you'll write a 3 or 4 sentence investment thesis, and then perhaps as you begin the report, you might put in an investment summary. Again, this is terrible. Even pros make these mistakes. By the way, this stock, I was recommending it at $6.60. About 14 months later, it got taken out for $15 a share, and literally, it traded from $6 to 15 like that. It was an event stock. But do not fall into those wording traps. Okay, now we're right to business description. First thing you do is you repeat back what the company told you about their business. Only you say it in English and common investor language, rather than language that's unique to the company. That's where you start. The next part is you synthesize and summarize all those things that you've learned. You probably shouldn't write more than 200 or 300 words of business description because your customer probably won't read much more than 100 of them. It's got to be pretty compelling. It's a complex company, you got to break it down into chunks, and then they'll pay attention. You have more words than that. But if it's Sprint, which basically has 3 businesses, prepaid, postpaid, and they have a wireline business buried inside the company, you're not going to spend a lot of time writing about it. Now here's something, you've probably seen this phrase come up a lot, return on equity. Is that something that you've talked about in your finance classes and your, does anybody know, or does everybody know what the DuPont method is? Okay, you guys are from where?
Metro.
Metro. Okay, how about UC Denver? You heard of the DuPont method? Good. Can you do the proof?
Have it in my notes.
Good, good. Okay, that helps me a lot when we're going to spend time. That is one of the most common languages among investors, is the ROE decomposition via the DuPont method. So I use that. Management, the words that are never spoken or written. When you communicate your thoughts about management, and you think management is really dumb, you don't say, I think management is really dumb. Yes?
I mean, if you're writing a buy-side report, can't you?
If you're on the buy side and you're discussing it internally, you can.
Yeah.
If you're writing it internally, that report will leak. I guarantee you, if you're working at a firm that's got more than, say, couple dozen people at it,
Yeah.
somebody within the firm will disagree with you violently, or have a friend that works at the company and send you the report. And then you'll get a call from somebody in investor relations telling you where to go and what to do when you get there. And you never return. So you have to be sensitive to this. The best thing you can do, if you think that management is a negative, is simply put up, is everybody familiar with ISI? ISI is a third-party rating company that rates governance and corporations. Get a synopsis of what they say. If you think management is really smart, for example, I tend to think AT&T management is a little smarter than Verizon management. Verizon management, not dumb, neither of them are. But I would say Verizon plays percentage tennis. It's there, it's always trying to do the right thing, it doesn't take a lot of risks, and it just waits for its opponents to make mistakes. And it takes advantage of it. Yes?
Quick question. I guess you kind of touched on it, but within our reports, is it allowed or is it generally recommended to use outside information, like you said at ISI, or
Yes.
like an outside source who's forecasting the industry or something like that?
You may have done, in the case of an outside source, it's a really good question. Yes, it's legitimate to use that. Okay? In the case of a bad company or a management you don't have a lot of respect for, that almost communicates to the reader that you don't want to say anything. You don't have to endorse their view. This is what ISI says. I'm not sure I agree with it, but this is how the company's rated. But yes, do source it to them. Don't claim it as your own work. But yeah, no, it's a legitimate thing to do. Yeah. Yes. ISI is one of those government manifestations that tracks every bit of data, whether it's relevant or not, puts it all together and gives the company a score. And then I write a couple of paragraphs about what's most relevant, what drove the score up, what drove the score down. But I would recommend that you take that approach. I think AT&T, I mentioned that I just said Verizon management is pretty smart, they play percentage tennis. I think AT&T management is pretty smart, they take risks. And usually the downside of the risks isn't too bad, and the upside is huge. Just think about the iPhone. They were the only mobile carrier in the United States to look at the iPhone and say, this is cool, we're going to do it. That was a pretty big risk, because Apple wanted guarantees and money up front. And it was a risk that paid off very big. But use those things as illustrations of what you think about management, as opposed to, gosh, I think these guys are great. Again, context, context, context. Okay. This is very cut and dry part of your report. You will probably have more fun doing this work, at least I always did, than other work. But however, this is going to be pretty straightforward, because at this point in your career, you're not going to be real nuanced about competition and communicating it. So, at a minimum, identify the competitors. Rank them by size. Maybe growth rates, ROE. Maybe there's indirect competition. And Arrow's, I haven't even looked at Arrow, but the company's third business that makes it a third of their revenue doesn't compete with anybody else, but it competes with all these other people. This is, again, showing your competence. Again, just keep it simple. Do you anticipate a change in competition to affect your forecast? Again, that's one of the most important things. If this changes, what's going to happen? Well, I think the competitive environment for Ford is not going to change much. GM, Toyota, Honda, Fiat Chrysler are all going to pursue their strategies. They're all somewhat different, but they're all facing the same basic equation, and they all deal with it in the manner in which they've been dealing with it for the last 10 years. So it's not going to, and you don't think it's going to change going forward. Of course, you might also say, I think Ford has this great idea of holding the paper for the auto loans. Nobody else is doing that, and that gives them a competitive edge. A, more cars. B, they know the assets in the loan portfolio. And C, they got out in front of this. And I don't know if they were first, but that was something that happened in the auto industry that changed the competitive dynamic. So if you see something in the electronics distribution industry that you think could change the dynamic, write about it. This is where you do that. Okay. The woman in the red dress who came in extremely late. I am unfair. Okay. No, don't worry about it. Porter's 5-factor analysis. Are you familiar with that model? Competitive analysis? No. Okay. Let me get somebody who knows Porter's 5 factors. Okay. Okay, in the back row, with the reddish, bluish shirt. Okay, give me a very quick rundown of Aero Electronics business.
In terms of the 5 factors?
In terms of these 5 factors.
Okay, so I started from the middle because that is the easiest part. So in terms of the power of buyers and power of suppliers, Arrow apparently is not that much affected by this because what we do is that they like the biggest suppliers like 5 to 6% of the entire supply base. So any one supplier is not very strong. In the same way, the buyer side also is the same percentage, around 10%. The largest customer is less than 10%. So again, the power of the buyer and the suppliers in the 5 process is not that relevant, is not that strong.
Okay, hang on right here. It's very relevant because it's low.
Yeah, so yeah, that's right.
And that makes a positive. When you use a tool like this to convey an idea, every bit of it is relevant. You're saying good stuff, by the way. I don't mean to undercut you, but it is highly relevant, your answers to every one of these questions. Yeah, how about barriers to entry? What does it take to become an electronics distributor?
A very good network, not necessarily.
Are barriers to entry high or low?
I think they would be high because you would need a lot of, in terms of, as a distribution company, you need a lot of assets in terms of your inventory, because you have to hold a lot of inventory from your suppliers, and then obviously your distribution model, whatever warehouses and stuff like that, that's very important, so I guess.
And that's a very valid opinion. I would say barriers to entry were very low. You pick something that you want to specialize in, like graphics chips, like NVIDIA's product. You become an NVIDIA single supplier or distributor. You identify smaller companies who are going to use NVIDIA's products, and you start your business there. Now, it may take you decades to get to be like Arrow, and there's a time barrier because there's advantages to that size. But step in is not so bad. How about substitute goods for Arrow? Are they generally available or not available? They are generally available. Everything that Arrow says is available somewhere else at a different price with different terms. Generally available. And then, have you gotten into the rivalry among the different distribution companies yet? Yes.
Substitute goods, I mean, with a company like Arrow, how do you differentiate between substitute goods and rivalry among firms? Because the products they sell are available from other firms. I'd say that's a rivalry among firms. What's a substitute good? It's a little different, you know?
Good question. Substitute goods are goods that are interchangeable or close to interchangeable.
Yep.
And that's a meaningful competitive metric. Rivalry is Porter's soft category. It's how does management and the company comport itself competitively. There used to be a company in the electronics industry, distribution business called Bell Micro Products. Bell came out of nowhere and grew to being a pretty good sized company very fast because they were intensely competitive. There was huge rivalry among the firms. In the cell phone industry, mobile communications industry, today, rivalry among firms is pretty high. You see John Ledger and Marcelo Fleury, the different guys taking shots at each other on Twitter. 5 years ago, that didn't happen. So this is more of a soft information point, whereas that is a much more focused one. Because certainly there's intense competition. Okay, I already talked about the historic. I think I've got, that's the chart that I drew on the board, if everybody remembers it. What basic message of that is to where has the stock historically sold, and not just from a raw PE basis, but that PE should be measured relative to the market. Sold for 1 times the market's multiple. That's another equalization tool. Makes sense. Comparative valuation. Okay. I think I have an eye chart here for you. This is something that you can get from FactSet. I happen to use Capital IQ because that's what we used at the hedge fund where I was working. What this does, apologize. You see all the competitors are listed down the side, and then here's your basic financial data about the company's capitalization. Here are their trading multiples, price to sales, whatever. I always find adding something like this, which shows the distance from the high PE or the low PE, lets you measure the potential. Like, if something is 0 distance from the high PE, you can almost say it's priced to perfection, or it carries it above market value. In the same time, a margin structure and the company's operating statistics are critical to influencing the valuation. So they very kindly give this to you on a different tab. Here's your business description. If you need to list it to help yours, list it. Just don't plagiarize it. Source it, or if you like their description better than the company's own description. And then here is something that gives you an implied valuation for the stock. Worst case, I think could sell for 56 cents. Best case, could sell for $64. Not very helpful. But this captures all of that, and this is a way that I think you ought to consider using in an abbreviated form in your reports. Okay, I'm going to go back to, but that's my third half hour is ended. Okay. I'm going to go with this, and then I will end it quickly. This is another example of where perspiration counts. I told you about a stock I recommended, Leap Wireless. By the way, that wasn't that long after my fall, and I hadn't recovered yet. And there is no market for brain damage securities analysts. Okay. Here are the major asset categories. Here's my assessed value, taking out the debt. Here's what it works out to per share. Notice I put 43.75. I also labeled that very vigorously not likely. Again, this is an example of where you put in the context. Now, this is a really nice chart, and why would you believe it? Anybody? You wouldn't. It's the right answer. Here's how we determine the value of a customer and what the customer base is worth. We look at the price. We look at the cost. We look at the margin. We look at the churn, assume an interest rate, and 8 years. And quite frankly, most of these things are defined in the text also. You get a net present value per customer. and you explain the computation, and then just show what that value is. Now again, go back to that other slide. That comes up to $1 billion. We said customers are worth $1 billion to $1 billion too, because we believe should churn is improved as we expect. Again, that's part of the thesis. We go with that. Now, the spectrum is a very fussy question. It's an area where I think I have some expertise. Most people on Wall Street do not. But you have a discussion as to what you think the spectrum is worth, high and low. High and low, I'm sorry. And then what those prices are based on. People track spectrum prices in megahertz per pop. And are these prices reasonable? Well, if you look down here, here's a couple of reasonable transactions, 63 and $1.59. So a range of 40 cents to $1.59 is probably not unreasonable. This is a very inefficient market. So you have very wide spreads. Okay, here's another rationalization. I said in network, many times investors are very reluctant to assign a value to a specific kind of asset. For example, they will not value the network of a cell phone company. Just it's a working asset, it's part of the deal, it's not anything special. However, if you think the company's going to get acquired, which is what I did think, you need to address, is the network a good thing or a bad thing? And here it is, I'm saying it's a good thing, about $2 billion worth. We'll stop here and come back in, you want to do 15 minutes or 30?
15 minutes.
Okay, back in 15. Great. There's vending machines downstairs at the other end of the building.
Just this one. So I'm gonna try and get it fixed.
Is his mic? Is his mic?
Yeah, it's there.
Yeah. Right now? Happy to. Hope it makes better papers. Before you saw the discussion between me and Mark. How important is grammar? Somebody got to have an answer. You can see this one came from Fox, the other one came from the New York Times. I was actually quite surprised at the outcomes here. You see this spelling and grammar check in Word? Does everybody use that? Okay. Do you look at the readability statistics at the end? You check that box on your options. You should. Because this is where your writing gets analyzed and your communicating gets analyzed in some very, very unarguable ways. Fleisch reading ease is what percentage of the population can read this and understand it. What grade level must they be to read this and understand this? And then I love this because in research, the most frequent sin is using passive voice. Does everybody know the difference between active and passive voice? Yes, no? Yes. The log was jumped over by the cat, or the cat jumped over the log? Which one sounds better? The cat jumped over the log. But they score it. Every once in a while, you're allowed to use a passive sentence. I personally think 36.3% passive is way too high. When I had analysts working for me in my research department, they weren't allowed to turn in the report until that was 10% or less. It's very hard to break that because in a passive sentence, the object, it shifts the voice from the subject to the object. And sometimes you want to do that. But it's a very sloppy way to do it. Now this is Fox. How do you think the New York Times did? Hopefully better. Now you noticed, I simply, sorry? Windows is so tolerant. Or Office is so tolerant. Here is the New York Times, same article. People are somewhat upset about this issue. Donald Trump is going to find out about security before he becomes president. That's standard operating procedure. So I looked at Fox and Times, figuring I had thought Fox would be sloppier and not as good of conveyance. New York Times does very well on the passive. They meet the threshold, which I think is very important. However, only 12% of the population can read the article and understand what they said. That's not very good. Grade level, not very good. 18th grade. That means I need to have 2 years after after college, I was really shocked because I generally think of the New York Times as extremely well written. If I hadn't looked at this one, I just picked 2 articles on the same topic from 2 different vendors. But use this as your tool. When I write research, I look at a grade level. I like to, my standard is somewhere between 9 and 10. I am always shooting for lower. I worked at a hedge fund last year that was just awful. The hedge fund blew up. My part of the fund made money. It was murder being there. I took to writing memos internally. The only memos internally that got any traction whatsoever is when I wrote at a 7th grade level. Because everybody was so wound up and wrong and were convinced that I was wrong. So I had to take it. So use these tools. Use the scoring. I use it all the time. And this will give you help on how to get your scores down. That's paragraph 1.2, that's kind of low. 26 words, 27 words per sentence, that's a lot. Probably where the complexity comes in and pushes the grade level up. Because you have to follow several thoughts in one sentence. But I strongly recommend that you use those tools. Okay, now we'll kick off the official second half. This is coming towards the end of the report. This is the forecast we're going to work on forecasting pretty much for the rest of our discussion today. Now, I break forecasting into 2 parts for the purposes of your report, because many people tend to think financial forecast is just that set of numbers that goes in. That's what we call 7B. Whoops. Come on. Oh, I didn't put 7B on there. I should have. Sorry. But this is very important, is that people understand why you think what you think about the numbers. Again, this is not a complex discussion. This is straightforward, set it down. I think their revenue growth is going to grow at 10% in the future. That's better than their 7% traditionally. The reason I think this is the new channel of distribution that they have added in Canada. And then you might say something, right now Canada is 5% of revenue. By the end of the forecast period, I expect it to be 30% of revenue. Something along those lines. Make sense? I think the Canadian business is going to be less profitable at first, but more profitable later. There's a learning curve, but that's what we say about margins. I think the new chip is going to be much more profitable than the old chip, because that's the nature of chips. But you state the things very clearly. The third point that I want to really focus on, because this was ignored, I believe, in every single research report I looked at last year, is what does the company have a need for financing? Okay. Why is that an important thing?
Well, if we need to go to the equity markets to get financing, it could be dilutive.
It can be dilutive. You can make it even simpler than that. It means more stock is going to be sold than is currently available. Supply is going up. Unless demand is going to change, all it means the stock's going to go down. Again, try to make it easy. Dilution is a very good point. Can't argue with it. Sometimes offerings are dilutive, sometimes they're not. It can go either way. But the idea is somebody's going to be selling more stock in the market. So the supply-demand balance, that's not going to help you. Now, it doesn't mean it's going to hurt you necessarily, but and you might like something even though they're doing a financing. So I've seen stocks go up in financings, which you wouldn't have expected, typically, but it happens. Again, you need to discuss these things at a minimum to convey the ideas to your customers. we have become very fond these days of using cash and non-cash, or GAAP and non-GAAP, or adjusted earnings. I think this is testimony to the fact that the accounting profession has failed. It is not good practice. It's not a good sign of things. The purpose of accounting is very simple. Okay? Accounting is to match revenues and costs and convey the results of that to the owners of the business. It's how the operators of the business communicate to the owners of the business. In this case, shareholders and management. Now we are monkeying with this conversational formula at great length. And this becomes, in my mind, a real issue. And we've simply seen this go to hell in a handbasket because accounting for a long time was in the hands of the management teams and got bossed around and did what management said to do. And then all of a sudden we had Sarbanes-Oxley in the accountants center. My job is no longer just stabbing the wounded after the battle to see if they're dead. My job is to tell you that you don't know what's going on in the left flank. Change the whole dynamic, and the accounting system, and this was called for by shareholders at some level, became very corrupt. Because we had to have all different metrics and all different things, and we lost that basic idea of matching costs and revenue and communicating in a consistent and comparable manner. Yes?
When you're looking at financials, do you put any stock, differentiate between GAAP and non-GAAP performance?
That's an excellent question, and the answer is sometimes, or mostly.
There's a huge difference. Investigate.
No, I wish you could make a judgment like that. Like, this is sound reasoning, this one is faulty reasoning. One of your jobs as an analyst, and decide this, and that's why I call this almost a disclaimer, because you have to make a judgment as an analyst as to what is meaningful. So if you think, or actually it's not just what you think is meaningful, but what you think the market thinks is meaningful. If every other analyst is forecasting adjusted EBITDA, you better forecast adjusted EBITDA so you have that consistency. Now, in your report, you can say this is nonsense, and this is a fallacy, and here's what's wrong with it. But you've got to express it the way the market anticipates it, whether you agree with it or not. So that was a really good question. Anything else? All right. Left credit points, asset utilization. Once again, my favorite thing. I'm an electronics and telecom guy, and that's the name of the game in those businesses. Everybody know what financial leverage is? What's financial leverage?
Debt.
Okay. Why is it important?
Shows the risk the company's taking on.
In terms of how it influences the financial forecast, what do you need to understand about your debt?
Obligation to bondholders.
You need to know the interest cost of the debt and be able to project it. You need to make a forecast, is debt going up or down, and why. If they're going to issue stock, chances are they're going to pay some debt down. So you have to, that's another check the box. You have to have an interest forecast. You have to forecast the tax rate. Companies will usually tell you that. If you don't, look at other reports and see how they forecast it, or ask the investor relations person what people are doing with their tax rate forecasts. Again, none of us are tax accountants. I was a forensic accountant for part of my life. I used to find fraud in companies. And what I don't know about taxes is extraordinarily profound. I don't even understand how it flows from the income statement to the balance sheet half the time. So, you can be a taker of a lot of this information. You don't have to make it. You don't have to say, Well, now they're going to do a third of their business in 2 years from Canada, and Canada's marginal tax rate is 60%, and America's is 36%, so their net tax rate is going to go to 43. You don't do that analysis. You're not expected to. Yes.
Which is, if there's any value in discussing like Trump's tax policy, he wants to cut tax rate across the board. It's like 15%. Should we discuss that?
You might. You might. In an industry where it becomes relevant to discuss taxes is when you have different companies in the same industry. When the competition, they have different tax structures. Okay? Government likes to take companies' cash instead of shareholders, so that becomes less cash for you. Now, in terms of changing tax code, you probably would push that back, not in the forecast, but push it back into the economic discussion, because that's a macro trend that affects all businesses. Now, how it affects a coal company different from a semiconductor company, you know, it's going to be different. And you might want to explain that if you're writing about semiconductor or coal companies. But that's more of a macro effect, not something you're going to drive it. These are the things that are going to change your earnings per share, going to change your cash flow. That's what's most important here. This is where you put it right on the line, and you tell the customer, this new Canadian business is going to be gangbusters. The rest of the street may say, Canada? There aren't enough people there to buy that many products. And you would say, you know, I've heard that argument, except that's wrong. Because those analyses exclude Quebec. And they're starting in Quebec, and Quebec is the most populous province. I don't know if it is or it isn't, but you have your set of reasons for why. And this is where you explain those. Put them right on the table and explain them in the forecast. Now, what forecast do you have to do? Mark and I, Mark's not here today, unfortunately. Mark Greenberg and I know a fellow named Ed Dunleavy. And Mark, who's one of the smartest people on the planet, actually said he was a good analyst about Ed Dunleavy. You have to understand, Mark Greenberg, for those of you who don't know him, he's the real deal. He's a very successful investor, and he's a very great analyst. Mark's statement is, when you're doing this, you're going to be wrong. It's where you're going to be wrong that you need to convey or understand. But you have to think about every aspect of your forecast and be able to answer questions about it. And then you have to present your forecast, quarterly consolidated statements, annual. Now, if you were working for Ed Dunleavy, who Mark admires, and who I learned who was one of the big influences in teaching me to be an analyst, you always have 2 years of quarterly and 5 years of annual forecasts in front of you. Again, like Mark said, you're going to be wrong. But this will demonstrate that you have thought how this company behaves in the cycle and what might happen. Write down your assumptions. I think there's going to be a recession in 2019. And you just simulate it. It's not important whether there is a recession or not. Again, this is to show what is important and that you've thought it through. Because maybe the customer thinks there's going to be a recession in 2017. And so he's going to look at your 2019 forecast, compare it to 18, and roll it back. Customers will do awful things with your model that you never intend them to do. But that's very important. Now, I am going to the units from a cell phone company.
On the cell phones.
It's pretty hard there. I'll show you how you deal with that. In the cell phone industry, it's not as straightforward, but you have to, in the case of Arrow, you have a pretty simple model of units. How many items in the bag? How big was the bag? key your metrics, your unit analysis off of that. Unfortunately, that type of unit analysis is standard operating procedure on Wall Street. It's when you get into more esoteric businesses like disk drives or cellular companies that people hold out. Okay, wrapping up on my last few slides here, presenting risks. CFA Society says it has to be there, FINRA says it has to be there, the SEC says it has to be there. So you better have some discussion of risk when you make a research report. This is one of those things where you're damned if you do and you're damned if you don't. Okay, if the economy collapses, this company is going to do horrendously because it's got a very low asset turn and incremental profits are approaching 80%. So the swing in profits will go from 80% in a good time, every next dollar of sales generates 80 cents of profit, to maybe 5 cents of profit. Because margins go in both directions, up and down. Everybody familiar with the concept of incremental margin? I'm seeing blank faces, is that right? Okay, I'll make it a point to talk about that later. But you have to identify the things that you think are risky, that Wall Street thinks are risky, that the company may think is risky, and then, once again, put it in context. We don't think this is their next product could be delayed because of an engineering defect. That's a risk in a company that invents stuff. Makes new products all the time. We don't think this is a major risk. We don't think this is going to happen because this company has always, or for the last 5 years, has delivered every product on time. That way you've identified the risk and why, and you've respected that. You have to acknowledge that risk is there, but you've also said why you think that's not going to be an eventuality. And that's pretty much how you present risks. You can go on forever and ever. I would pick 5. Now, we've been talking about the context of writing reports. And much of what you do is writing reports. But you have also seen me, and I've called on almost everybody, I think, to verbalize something. What is the difference between written and verbal communication? Yeah?
Written is on record.
Yeah. Well, verbal can be too. It can be. It isn't always, but good point. You can be stabbed by what you write later on.
Generally, I think it's harder to communicate verbally with something complex such as this because you have time to write it.
That's exactly right. You have as much time as you want to write something, and when you're speaking, you have somebody's attention for 15 seconds. And that's what you have to think about. And you keep hearing me say investment thesis, investment thesis, investment thesis. I think Sprint is going to be a good investment because its network is getting better and they are getting out of debt very rapidly, much more rapidly than the street thinks. Now, when I look at risk, Loop Metrics, I'm sorry, the people who rate the cellular networks, I look at Sprint, and it's still not very great. Very good, but it's getting better. Again, I just gave you a fact in context of the investment thesis. You're probably not going to talk about Sprint's asset turn. Unless, of course, like in the case of Cisco, they completely changed their internal processes and it was a big deal, as my friend Jean-Louis told me. But you have to be able to convey your idea very quickly, and that investment thesis will, again, be your most powerful tool to keep you in context. Valuation, you stated up front, why? I'm sorry?
It's what the investor cares.
Every investor cares about valuation, that's right. And it's common language, whether the guy's a deep value investor or a growth investor or a momentum investor. They all care about it. And they all use the same words, and similar formulas. So you have to have valuation there. It's like with the written report, give your conclusion first. I think you should buy Sprint because the network is getting better and they're paying down debt. Fewer words is always more powerful than more words. Hopefully I've demonstrated that. If I haven't, I have failed. Brevity is next to godliness. I used to tell that to my analysts. If you can make something that a customer can repeat to somebody, then you've really scored. And you should always be thinking about that as you're giving a verbal presentation. And let me try and think of an example. Straight Path Communications owns an awful lot of spectrum. Right now the FCC is investigating it, so you don't really know how much they own. But even if they only get to keep 1% of the spectrum, it will be high corn in Iowa. Meaning they'll become fantastically wealthy. Use a euphemism, use a metaphor. Mix your metaphors. I always do that. I hope I haven't done it too much here, but it's rocket surgery. You got to do things verbally to keep the customer engaged. Apple hood and mother pie. And then you can always use pictures. Typically when an analyst goes out to make presentations, they have a slide deck with them. The slide deck should be just second nature. It's the most important things from your research report shown graphically. If you just do it like this and put your thoughts in this kind of order, you'll do fine. Again, the thesis is the key. Okay? Now, last note is to keep it simple. When we were discussing this class, I had made a proposal of what the class should be, and of course, it got passed around to other people in the society. And this was a comment I got back. Now, quite frankly, I didn't even remember which section 1 was and which section 2 was. But this person put everything in there. That didn't convey very much, did it? This is something that I got a long time ago from a friend who was helping me with my writing. Remember I told you I had to improve my writing when I got out of school? Maybe I didn't tell you that. I did. I went and took classes in business writing, many of them, to get better. And I think this is a great example of simplistic writing. Take a look at that. What did you do last night? Oh, I had to get into a meaningful romantic involvement with Cher. I fell in love with Cher, which conveys more. I'm sorry? Second one, simplicity. And the final sentence there is one that I always keep in mind whenever I'm writing almost anything, even if it's just a note to somebody. If I can't write the idea or what I want to convey on a business card, I'm not conveying the right thing, or I don't have something to convey. And that's how you need to think about your own thoughts and your own writing as you assemble a research report. You look puzzled now. No? Okay. This is critical. If you want to see more things like this, there's a book called Gray Matter. It's called Gray Matter because it's about Harry Gray. Harry Gray was the CEO of United Technologies. And he started doing these things in the 70s and into the 80s, where United Technologies every few weeks would take out a one-page ad in the Wall Street Journal. And this would run down one side of it, taking up no more than 20% of the page. Most of the page would be black. Harry Gray is the last guy you would expect. United Technology, military defense complex. What's he like? Well, Harry Gray changed a lot of minds with these things. He did one called Let's Get Rid of the Girl. which is the most frequently reprinted one. And it was, the girl is not the girl. The girl is a woman. They have a name. And it was a rant like that. So I would recommend Harry Gray's book to almost anybody. And it's good writing and B, it's very good thinking, and they're lots of fun. Now you know just how much of a geek I am. But I would read something like that with pleasure. Okay, now we're going to go into the next part of the change this. Now we'll see the same thing at the same time, I hope. Okay. Now, this is Tableau. And Tableau starts here. For a moment. And these are basically an excerpt from my Excel workbooks. And it's aggregated up. Post is the whole industry. AT&T is the industry statistics. Verizon, T-Mobile, Sprint. There are others back there because you have to have them in there for historical comparability. This is actually collects very little data. It computes a lot of data though. It takes the number of subscribers, the churn, and then the ARPU. Those are the three core data statistics that you get from the companies, from all the companies. And then it turns this, hopefully, into some pretty good competitive analysis. Not every chart is perfect or great. What do you think about this chart? What does this tell you? Now there's a change going on in the business, because this one was leading pretty solid and let down. And this changed. What changed? Well, service prices came down and hardware prices went up. Wasn't that affecting the industry? Not much. And this is an example of how you torture yourself. You do year to year, you do sequential, you try to figure out which one tells us the more compelling story. There's probably 80 graphs in here. I might publish 5 of them. I always run all 80. And sometimes customers want some that they like. We do for them. Here's pricing for service. That's your unit metric for cell phones. What would the unit metric be for Aero? Bags.
Components per bag.
Dollars per bag. Yeah, exactly. What's the average sale? What's the price of it? What's the margin? And then from that you can back out the margin, right? How do you do that?
Track the costs from
You don't have that. You don't have unit costs. You only have the fit income statement. How do you know what that bag costs? Okay. It's easy. You know how many transactions you got because you have the average bag. Good. Right? Do I have everybody out? I can get 10 trillion or whatever, however many cells in it. Take it one step further. You know the cost of goods sold, so you know what that costs. And that's going to vary, period. It's going to vary more than you ever think it would. Again, this is something that you can do and claim for your own that most of Wall Street does not do. Most of Wall Street just does what is pragmatic. This is unit analysis, and this is very, very helpful to investors. Question? No? So, you do a bunch of things. For a while, we didn't, you see, there was no price war in the cell phone industry. Remember, for how many years have we been hearing about price war in cell phone? Price wars for cell phone service. But handsets, which used to be free or very low price to the customer, went up considerably. And here is one attempt, hardware buyer's yield, which is hardware revenue, but to measure that. Here is another attempt, similar looking graph. That's just looking at hardware. And you can expand this to look at average billing per unit. And I originally called this SHARPU, which was service and hardware average revenue per unit. And that chart, again, continues to go up and to the right. We had a big recognition of that this year. We had about 2 years of underperformance, 3 years of underperformance of these stocks, and then they all snapped. They snapped because of yield, but they also snapped because their margins did not collapse, because they were taking in more revenue. And again, this is what the unit analysis can tell you that you won't get from somewhere else. It was an analyst, Steve Nicholas, who I thought was one of the best analysts out there. He had great earnings estimates. He was spot on. More than anybody else, he was recognized by Starmine for being accurate. He was a pretty good stock picker. And then he wrote a report that said, I can't forecast this industry anymore because of pricing. He abdicated his responsibility. He was with the company approximately 4 more months. And when the layoffs came, he was one of the first to go. You have to predict the unpredictable. You have to forecast the unforecastable. That is your job. Now, I think it's a really fun job, because I like the intellectual challenge of defending it. I argued against the price war for 2 years. I was dead wrong on the stocks. They were terrible, except for T-Mobile. Even then, that wasn't that good. And now, a few months ago, probably the middle of last year, the market started to figure out, oh gosh, prices are going up, not down. This is good for the telecom companies. And all of a sudden, they went from yielding between 4 and 5% to yielding between 3 and 4%. Huge move in the stocks. So, doing this unit analysis is your radar. Don't be afraid of it, because nobody else is doing it. Or most analysts will not do this because it's too much work. This is something that's fairly simple to do. You just start dividing things by unit volumes to get prices and revenue. And you know, whoops, what is that one? Continue to go up, fall off a little bit, but it's not, it was worse in 2009. And then you have these wonderful things, rate of change graphs, which can be completely misleading because it's the rate of change. And even though the rate of change went down here for T-Mobile, you would have thought something had gone wrong at T-Mobile because it was here and it went there. Things at T-Mobile were going very well. It's still positive rate of change of 5% in line with the industry. It did ultimately decline, but it's not always. Here's another one. I don't know why investors put so much stock in these. Well, I do know why. Investors put so much stock in these because all the definitions of what happens below them, what's revenue, what's cost, what's profit, what's earnings per share, they're not trustworthy anymore. So people look for rates of change to try to understand and identify the trends. That's what these things are good for. Competitive position, net additions, gross additions. How the customer is responding to the current service offering. Okay, that's the gross number of customers that are attracted to carriers. They don't disclose that. How do you get that? They disclose churn. They disclose the number of customers. How do you get gross additions? Okay. This is not hard. And we're going to compute churn. We're going to compute gross additions out of churn. Okay, this is a carrier whose churn went down and the customer base is relatively standard. Churn is expressed as a monthly number. And this is something you need to be careful of when you're looking at statistics that companies give you. Reflexively, you want to think that it's a quarterly number. But a lot of times, the data they give you is monthly. So the average monthly churn in the quarter was 2%, it went to 1.5%. Which means we lost 0.5% of our customers per month, basically. Follow it? Divided by 3, you get the average. 604. 1,000 is the average. We there? Making sense? Yes? No? Am I not explaining this well? Okay. So if they lost, let's see, 4.5% of 604, who's good calculator? This is what I lost when I hit my head. I used to go over this stuff constantly. 4.5 times 6, what, 27? What? 26, 27. Right around it. Maybe it's coming back. They lost 27 customers out of the 603. How many customers did they gain to get to 605? Well, right. They gained 28 customers to get to 605. But that is your net additions. What were your gross additions? I'm sorry, that's correct. Your net additions is plus 1, loss of 26. Total people attracted to the service, total customers is 28. That's exactly right. I'm sorry, I screwed that up. But it's manipulating the numbers, looking at what's happening on the margin, what's happening with the customer. And it lets you compare how attractive is the customer to the carrier service. Well, service pricing, for a long time, Verizon did very well. It was the top, best network. They actually had very good prices. AT&T, not quite as good a network, more expensive. Sprint, for this period of time, was the highest priced carrier out there. And they had the worst service. They didn't do so well. And then T-Mobile, you can see they're improved because they were, and that's all but. But look, and this simply adds up all the 28s for the different companies. How many customers did they attract? That's something you're going to want to do when you analyze how many customers Arrow had. Because they'll talk about it. Or they'll talk about repeat business and have to back it out. You constantly have to back these numbers out. You have to be creative about how you think about it. When you were thinking about what does that bag cost, you were like, oh shit. They bought a processor, that's pretty high margin. He bought some memory chips. In today's market, that's pretty high margin. But he bought a bunch of capacitors too. And the margin on capacitors isn't that good. You can go drive yourself crazy with that. Your model tells you this. And when your model can tell you this with a certain amount, so you have a feel for those numbers, you can internalize it. You can then make a better forecast than anybody else. And if you're smart, you start at the lowest possible level you can, because it's easier to forecast. Companies going to tell you that their prices go up or down. It's a 2-year contract, so prices are fairly sticky. So you have a rough idea of what pricing is going to be for the next 2 years. Okay? I mean, it's not rocket surgery. But doing the work at this level makes it a whole lot easier to justify your revenue forecast. Which sounds better to you? I think Sprint's revenue is going to grow faster than the industry because they have been adding customers faster than other carriers. Let me show you that on this chart. By the way, that doesn't show that. Or I think Sprint's revenue is going to increase by about 4%, which is a little bit more than the industry trend line. Which forecast is going to be more accurate? Actually, you don't know. You're going to be wrong when you make forecasts. That was a trick question. But so don't expect to always be right. The forecast might have more validity if you just 4%. You know, if you want to read about forecasting and the pitfalls of it, there's an excellent book. You've all heard of Nate Silver, okay? Separating signal from the noise. Why so many projections fail. It's a phenomenal book. And if you're going to be an analyst, you should definitely read the book, just because you will know how wrong you can go. Because he'll show you what's the fallacy of earthquake forecasting. What about meteorology? Why is the forecast what the forecast is? You know why? The forecast is what it is because the weather services don't want to leave you stranded on a bad day. So their forecast is always going to be somewhat worse than what they really think the weather is. There's reasons for that. Analysts. What kind of analytical biases do you think there are in forecasts? White shirt.
I would say that financial forecasting can always be somewhat biased and more positive. Or not positive, but more skeptical. The risk factors and maybe have a more negative outlook than someone else.
Yes, sir.
I think it would depend on whether they're outside or sell-side analysts.
That's a good answer.
Sell-side, but more optimistic, buy-side, it would be a little more pessimistic.
Also, the market goes up more than it goes down, so you might as well skew.
It colors your estimate.
Yeah.
Direction of the market certainly does. Actually, these are great answers and good thoughts. Sell-side analysts tend to be pessimistic. Strategists tend to be better forecasters, which is why I asked that trick question before. How many and how much? You got a nice number there. And then the other guy goes, 4%, that's what it's going to be. It's just a difference in forecasting. What you're there to do is to explain to your customer that you understand the business and to justify why they should invest or disinvest in it. It's as simple as that. Sometimes you're there just to hold the customer's hand, affirm what they already believe. But the bias tends to be low because if they exceed your estimates, that's a positive thing. If they miss your estimates, you're looking really stupid. It's just like the weather forecaster. You have to understand those biases. Hey, Garrett. Now, I think I've shown you enough stuff about... Oh, here's one that's kind of interesting. This one is a real tortured one. And this one has been brilliant for me, personally. Everybody talks about monthly churn. How many customers, what percent of their customer base do they lose every month? As the ultimate metric. But is that really a relevant metric? Yes or no?
Depends on the business.
Well, yeah, but it also depends on the nature of the business. For example, you're measuring monthly against a gross total to get the churn. But what if you have, in that example of 600 or so customers, 400 of them renewing in the month of September, and the rest of them spread out through the rest of the year? Your churn is going to go through the roof in September. So what do you do to take that out of your forecast?
Average it over.
You make a projection for how many customers are coming up for renewal based on what happened 2 years ago. And then you look at what percentage of those did you lose or keep. And you get a retention rate that is much more helpful than a churn ratio. Everybody follow that? These are the types of things you need to be doing when you're doing your unit analysis. I'm going to turn off Tableau. Put my glasses back on. Bring up another model. Now you want to build a model. Here's a really ugly model. In fact, it's probably my ugliest model. It's way too complex. But again, this is my work. It's not necessarily what I share with customers. Here's some things you might consider doing. You see how all these tabs down here, they're orange? That means it's data that the company gave me. There's very little manipulation in these pages. You know, I do checksums and things like that to make sure I've taken it down correctly. But I find it's extremely helpful to keep the data separate from the model. They give you a lot of data. This goes back to that, you know, why SQL is better than Excel. It just doesn't have the tools for analysis that Excel has. But you have all of this stuff. And by the way, what they report in September of 2015 and in September of 2016, you might get a different answer. You have to continually update this because companies will tweak their numbers. They will have sold a business that's a minor business. They will have had a litigation settlement. There can be lots of reasons, and they don't call these things out. So how do you cure that problem? Okay? You go to the most recent one, the most recent report, and that's gospel. What they said they did in September of 2015 is what they did in September of 2015, even if it's different from what they reported on their 10K, Q, and press release in 2000, in that period. Everybody understand the purpose of that? The other thing is this goes to FactSet or Capital IQ. They will tell you what is the source of this data. And you'll look up the column head, or actually I don't have one of those handy, at the column head, and it will tell you 2016 September 10Q, even though it's a many periods back. Because there's particularly large companies who are always fiddling with their numbers. So the message here is to keep your raw data separate. Now see there's a very lengthy chart. That was a chart I was always going to do. I finally did it on a later version of this model, so I would know how much cash they had to come up with. And that's, again, disclosed. And then there's some subscriber data. And then these here are analytical things that are not reported, and things that you probably keep for yourself, or you might surface some of it. You might surface the value of subscribers. But you do that kind of work. You'll notice that's at the back. I also will put obsolete data in the back of the model. because companies change how they report. Like, used to report like this, and now they report like that. It's just different. But you always want to keep that old data around as a reference. Everybody with me? Have your feet fallen asleep? Not yet. Okay, good. Now, where you do your work is back here. Is you. Oh, I remember this. This is what I call scorecards. For a brief while, I had a great assistant. And he would make a scorecard for me for what was my estimate, what was the prior year, and what did they actually do, and where did we get it right and wrong. So you could look at different businesses. That's a very helpful thing. You have to get used to the idea of telling your customers that you were wrong, or documenting how you were wrong, because you're not going to get it. I guarantee you. You may be dead right on the stock. You may make a lot of money in the stock, up or down. But your forecasts that support that projection for the stock are going to be wrong. I mean, so don't sweat it as much as you think you need to. Everybody looks at earnings per share. You've got to do it, but you're going to be wrong. Just, you might get the right earnings per share number, but they might have gotten it because they reported no taxes. Then you were horribly wrong. And companies do that. I mean, trust me on this. I've been wrong by more ways than I can consider. Okay. And then I have a bunch of graphs, which I have given these graphs up because to update these, you have to go into each graph and iterate one column forward. So I use Tableau now. But we can do a lot. Now here is the tab where I really drill down into Sprint CDMA business. This is painful. And what this does is this pulls data, and you can see where my estimates start. There's a market with an E, and go forward. You won't find. Let's find the data of it. See wireless AN6. If it goes back to that wireless tab, just pull the data there. And then that's computers Excel AB10. Again, painful, it's Excel. But do your work like that. Build up the businesses from the bottom. Now, here's the wireless business without units. Here's total revenue. Income, cash flow. Now, it's a lot of data, isn't it? Painful. That's why you get paid big money to be an analyst. You're doing the work. Now you've seen what goes into a model. Let's talk about what you need to model. I'm going to put this up probably right on the board. Does everyone understand or comfortable with the idea that the income statement, the balance sheet, and the cash flow statement are interrelated? Yes, some people not. They are, first of all. And there's very clear linkages. It will tell you, and you will need to know and understand how those things work. You need to know how these things relate to each other. Okay? So, I have never done this before, and I'm working without a net today. So, please bear with me. You have units. You have an average selling price. And you have revenue. Okay? Okay, perfect. Did the company, during its operations in the quarter that it just reported these three facts about, buy that number of units? It probably didn't. They have units in inventory. They have units being assembled. They have changes in inventory. So you have actually units are purchased. Some are recognized. Others go into inventory. Make sense? Yeah.
Would it be possible to turn on maybe the light?
Oh, sure. Sure. Actually,
It's,
I'm pretty sure that I have no idea.
I read it.
Thank you. While you're doing that, what's a credit?
Trade credit or
A credit in accounting.
entry on the right side.
Okay. What's a debit?
Left side.
My second level accounting class, the teacher got up in front of the class and said, a credit is a right-hand entry and a debit is a left-hand entry. He stood next to the class, said the same thing, stood behind the class, he stood on the other side, got up and asked that question. And I was completely mystified that 2/3 of the class, well, a credit, if you have a liability, a credit is this, but if it's an asset, a credit is that. Well, it doesn't really matter. It's just a left and right hand entry. And that's the beauty of how these statements link with each other. I'm very pleased to see that you all understand that. Okay, so you have inventory. Now, inventory went up. What happened to cash? Went down. You bought more inventory than you purchased. So that change is reflected on the balance sheet. Right? Okay? And how does it show up on a cash flow statement?
Outflow. Operating.
These things would all show up in the operating cash flow. This is too basic to say so. But a cash flow statement has, the first part is cash from operations. Okay? And that considers primarily, and people will argue with me about this, and you can feel free to do that also. But this is pretty much how most people do it. Okay? You'll find people argue about this all the time. The impact from the P&L is the first thing. There. Okay? And that's recorded as several things. Net profit. The first line. Uneasy. The next, cash flow from operations. And so inventory, receivables, payables, those are your big ones. Okay, if you increase inventory, the cash go up or down? Down. If you increase payables, does cash go up or down? Capital spending. Anything else? There's lots of things. Sometimes companies will buy stock in other companies in a joint venture. That will often show up here. The cash impact of that purchase. So you have to pay it low. I think I had 4 X's there. Okay, that's the income statement, adjusting for non-cash charges to income, putting them back in, and taking out or adjusting for changes in current accounts. Then you have investment cash flow. But do we care about that if we're judging a company's operations? No. What we do care about, though, is what came up several times, capital expenditures. All right? You take out this, and this is a very important statistic. This is called free cash flow. It's what the company, it reflects what the company generates in its operations and what it needs at a minimum to reinvest. So this is a very important number. As accounting, as accounting gets worse, which it has been on the last 15 years, 20 years, accounting has gotten steadily worse. This number becomes much more relevant. And it's critical that you know this number and compute it. This should appear in all of your research reports in your financial modeling. Now, that's a pretty good statistic, right? Tells you what the business did. What else does a business have to do? Yeah?
Pay off its debtors.
I'm sorry?
Pay off its debtors.
Pay its creditors. They're the debtor. Credits, or right hand. So this is free cash flow, and this is what would be referred to as levered. Because the cost of interest is computed in here. Because that's back up in the P&L, and you start with net profit, and that's a real cash cost of course, that stays in there. If you wanted to make a case for an enterprise value of an entity, you would want to take the interest cost out. Is that not correct? So, and now we have, and then this would be unlevered. Sorry, I don't know it very well. Unlevered free cash flow. Because you took the debt out. The debt was present. Debt is present, it means there's leverage there. The debt's not present, there's no leverage there. Everybody follow that? When you're dealing with enterprise values, and I presume you all know what enterprise value is? No? Yes?
Yep.
Not sure. Okay. Very briefly, enterprise value is the market value of the stock so they've got 10 million shares outstanding and they're selling for $1, so it has a market value of $10 million. The company also has $3 million in debt. How do you deal with that when you value a company? Sorry? Add, subtract, credit, debit? You have an answer here?
Add it.
You would add it, because that $3 million is part of the invested capital in that company.
Subtract cash.
Right. Thank you. That's your enterprise value. Why is that important? Come on.
It's like a starting point for what it takes to buy the whole business.
That's right. It's the cornerstone. It's the foundation of every bit of valuation work you're going to do. Because if you're dealing with a company, let's say they have a $10 million market cap, but they have $11 million in debt. how does that, when you talk about the market value of stock, that's irrelevant. It's a small number. Because the debt carries most of the value. So it's important that you understand this, because again, this is trying to get back to a pure number, not an accounting number, and match it up with free cash flow, which is another pure number, not an accounting number. Follow? So you have unlevered free cash flow. These are the two numbers. These two numbers are going to be critical to your presentations to customers. You notice there isn't any gap here. We've adjusted GAAP out of it. Okay. You might think about valuing a company in terms of multiples of free cash flow or unlevered free cash flow. That's increasingly where the street is going. PE is becoming less relevant because the P is not consistent like it used to be. You used to be able to count on accounting for consistency. Now it's not consistent. I am hopeful that accounting will become more consistent. You guys follow accounting rules. Okay, you need to understand accounting rules because they're going to change. Not for the purposes of this challenge, you're not going to deal with any of them. But right now, the American Institute of Certified Public Accountants is changing the way revenue gets recognized. Can anybody tell me how revenue gets recognized today?
In the period it's earned.
What?
In the period you earn it.
How do you know when you earned it? When the customer accepted it? When you ship it to the customer? Do you have an ongoing obligation to that customer? What percent of the value, total value to the customer is that ongoing obligation? Now, if this is a subscription and the customer is obliged to pay you for 3 years, do you recognize, if he's going to pay you monthly for 3 years, do you recognize 3 years of revenue? Or do you recognize a month? Pretty convoluted. Really quickly. There's all kinds of things that the accounting industry has done on revenue recognition. And the proposal now, and just be aware of this, I'm optimistic, it makes me optimistic, is that we're going to go from having all of these rules, because how you recognize revenue for a software product and a hardware product is very different. How you recognize revenue for a hardware product that has software with it. How you recognize revenue for service contract and subscriptions. There is no equality, and there's considerable, you'll forgive my monkeying, very technical term, with how companies recognize revenue. They have a lot of latitude because the nature of rules are, the more rules and the tighter the squeeze, what happens? Okay? The more that escapes. The more regulation and the more rules, the more ways people have to think up these regulations and rules, and then other people say, oh, how can we beat that? And the more escapes. So we're going to, for revenue recognition, and this is a huge change, a principles-based approach rather than a rules-based approach for revenue recognition. And that puts the onus back on management to recognize revenue in the way that they think is right. Now the principle says, pay attention. If it's a subscription, you got to do this. But you will now know from the company how they recognize that revenue. Well, revenue is probably the biggest factor in earnings, usually. So this is a big step forward. So maybe we can get away from this. But for now, you need to understand free cash flow is your operating cash flow, or net income plus depreciation. That's your operating cash flow. Less capital expenditures is your free cash flow. That's what the company really has left over. And then unlevered free cash flow, if you want to look at the business purely as if there was no debt, is a different number. Which is the largest number?
Unlevered?
Unlevered free cash flow, that's right. Actually, operating cash flow can also be the larger number. It depends on how big these two are relative to each other. So, everybody think they can model that and forecast it? Yes? No? Okay, good. Several of the people in the society asked me specifically to do this. I wasn't planning to do that one. But
Quick question. So when we're forecasting free cash flow, would you go about doing that by forecasting out the entire, doing pro forma balance sheet, income statement, and cash flow statement, or would you just?
you know, that's the question I'm going to answer next.
Okay.
Perfect.
We'll get to it then.
All right. The question was asked is if we're going to do this, do we have to forecast everything? And the answer is yes, and I'm going to show you some tricks to make it easier. Okay. Now, you all know the DuPont method, and I just think of it as sales over assets, assets over equity, times pre-tax margin, or PTI over sales, times 1 minus the tax rate, you get ROE. This is a pretty cool little tool because it lets you look at a company for numbers and very quickly assess how that company compares to its peers and how it compares to other companies. It teaches you a lot very quickly. It's my favorite shorthand. It also is your roadmap for building your models because your income statement has to flow into the balance sheet, has to flow into the cash flow statement. How do you do that? Okay? So this model here is pretty good. So we forecast income, units times A and B equals revenue, and units times unit costs equals COGS. Sorry. And then subtract one from the other, and you get gross profit. Okay, you know we talked about how to do these things already, right? How you can arrive at these. You're going to have to back into the history. But that history that you developed when you calculated these numbers before is what forms the base of your forecast going forward. It tests for reasonableness. Okay? Are you with me? Okay, great. And then you have operating expenses. And you have operating income. And you have net interest, because you can, some companies have interest income. And you're at PBT, profit before taxes. If you can get this much more or less right, you are doing a really good job. You're also doing barely enough to step into the room. Which is my way of saying this isn't necessarily an easy thing, but you have to do it. Okay? Remember we talked about taxes before? Be a taker of information about taxes unless you want to become a student of taxes. It's not worth it. Okay? So we have the first step, the first line of our operating cash flow. Right? And that's the net profit. We just talked about how you go about forecasting that. How do you forecast depreciation? Come on. It's not that hard.
You do it as a percentage of assets.
You might. As a percentage of capital asset, property, plant, equipment. That is one good way to do it. You might take a look at, is capital spending going immediately up or down? Because if a company has a capital spending where they spent a bunch of money, like upgrading their network, their depreciation is going to go up into the future. If they're not spending enough, their depreciation is going to go down. Again, it's not rocket science. Typically, companies will stay within bands. And if you back out that number as a percent of revenue, or percent of PP&E, or percent of total assets, or even just long-term assets, you'll be able to forecast depreciation. Everybody got it? Make sense? Okay. So that's depreciation. We all know how to forecast that. Okay, how do you forecast the changes in accounts receivable, inventory, and payables? I'm sorry?
5% of sales.
As a percent of sales. Any other guesses?
Like days inventory terms or days sales outstanding.
That's actually a much better way. Percent of sales is very valid. I'm not going to tell you that you were wrong or that was a stupid answer. It was a good answer. But the conventional way is to do for accounts payable, days sales outstanding. Again, days sales outstanding is you take the quarterly revenue divided by 90 divided by the payables, and it's the average payables. I'm sorry, average receivables. The Polish accountant. Ran off with the payables. Your average receivables. Yeah.
Just a question on that for the average. Is that referring to just that one period or looking back? Because I've seen it done both ways.
Yes, this is something where there is no gap, there is no consistency in how people do it. I do it taking the average receivables that were outstanding in the period, which means just taking the prior period's receivables, the ending receivables, and averaging the two. But to be more accurate, again, this gets you back to those rate of change things. Because people will argue what that number really is, but if you watch the rate of change will be very consistent no matter what your calculation is. It'll be pretty close to each other. Whereas you might get differences of 10, 20 days, depending on how seasonal business is. Okay? So you, again, calculate this backwards, and then you'll notice it's fairly level. So you have to make a forecast of how much business you're going to do, what your revenue is. You forecast your revenue up above, you divide it by 90 in a quarter, and you divide it by, and when you're making a forecast, this is why you get into this thing. I usually use the prior period to try and guess the next period's receivables. You could put average in if you want, pain in the ass. Again, I do it, not everybody does it. I'm old. Okay, how about inventory? How do we forecast inventory?
Turnover.
Sorry?
Turnover, then use your sales forecast.
That's exactly right. Except you don't use the sales forecast. You use cost of goods sold. Okay? So your inventory turns, lazy analysts will use the sales. And I have a feeling that's become more pervasive. But it's cost of goods sold annualized divided by average inventory. That'll give you a number. You understand why it's cost of goods sold, not revenue? Because you're buying in your inventory at wholesale. You're not buying it at retail.
It'll show up on the balance sheet.
Yeah, it shows up as a cost. I mean, it flows through the cost part. Again, cast these backwards, and you have a foundation for going forward. How about payables? Okay. It's this in reverse, or it's just this again, except you put COGS there, and instead of having receivables down there, you do the payables. That's how you forecast the big parts of your balance sheet. You have to make a guess at what capital spending is going to be for the next few years. Get your free cash flow forecast. But the companies are usually going to talk about that. And again, if you do some metrics on capital spending, like what percent of revenue is it, or what percent of costs, or what percent of assets is it, you have a foundation for forecasting CapEx, because normally companies stay inside of bands. You know, once in a while a company will break way out. That's an unusual event, or break way less. But they'll tell you that ahead of time. It's part of the joy of Sarbanes-Oxley. They tell you these things. They didn't used to. So that's how you would forecast your capital spending. Those are your big elements for free cash flow. You know does everybody know how to forecast interest expense? You look like you know what you're doing.
Well, I don't know about that, but I mean, gonna look to see if you need to add debt or what's going to happen to your debt levels, and then go from there, and assumptions about your interest rate.
You have short-term and long-term debt.
Yep.
Long-term debt is pretty stationary, and you can measure that very accurately with how much you're paying. Short-term market, not so much.
Mm-hmm.
But your point is you got to figure out if you're going to be using cash or generating cash.
Mm-hmm.
Going back to that, what happens? Okay, we're going to wind up. This is one of my favorite points. What happens when a company grows at a higher rate than it returns equity?
If they go out and raise some type of capital.
They need to raise capital. Exactly right. That is a big warning sign. So, on that note, I will leave you. We can turn the YouTube thing off. Please turn the YouTube thing off.
I'm working on it.